Hello students, welcome to online class. In today's class, we'll discuss regarding the different stages in the growth of financial services. Okay, see this topic is important for 15 marks. So please be attentive and make a note that the topic is very important. Okay, so let's begin with the topic. Economic growth and development of any country depends to a large extent on the efficiency of what developed financial sector, right, which includes what financial institutions, financial markets, financial instruments and financial services. So growth of financial sector directly or whether indirectly it contributes for the economic growth of the country. So growth of financial sector is an indicator of an economic development of a country. With the liberalization, privatization and globalization of the Indian economy, financial services has undergone massive changes. So this can be studied into three stages. The growth of the financial services is studied into three stages. The first stage is before independence, then is after independence till 1990, and after 1990 what growth and the development has been taken place in the financial services of the country, that we are going to study in this topic. So this topic is divided into three stages. As it is a very vast topic, it is divided into three stages so that we can understand it very easily. What are those three stages? The first one is before independence, then is after independence till 1990, and then it is after 1990. So let's study these stages one by one in detail. The stage 1, that is before independence, what was the growth or the development which has taken place in the financial services, that we are going to study. So pre-independence financial services were characterized as unorganized. See, before independence, financial service sector was not organized properly as it is organized now, right? As it was before independence, organization was not known to the public, so proper organization was not there in the financial service sector. Next comes is few industrial securities, that is stock exchanges had very few industrial securities. The stock exchange market, okay, had very few industrial securities which was traded in the securities market. Very few industrial securities were introduced as the public was not confident about the stock exchange market and they were unknown. They were not knowing or they were not having any kind of a knowledge regarding the trading in the stock exchange market. So very few industrial securities were traded in the securities market. Then comes is no separate issuing institutions. There was no separate issuing institutions to issue these shares and securities like mutual funds and other agents. Okay, nowadays these mutual funds and the other agents are introduced for issuing the securities. Separate, these are what separate issuing institutions, right? Such separate institutions, issuing institutions was not introduced before independence. Then comes is no financial intermediaries. Yes, as there was no separate issuing institutions, participation of financial intermediaries like brokers, jobbers, okay, had almost been nil in long-term financial or financing of industries. Next is restrictions on outside savings. That is, industries' access to outside savings was also restricted. That is, outside saving might be whether it is outside the country or whether it is outside the state, was restricted, right? But nowadays it has opened the economy for the other countries too. But earlier, before independence, before liberalization, privatization and globalization, access to outside savings was restricted. Okay, so from these characteristics, what we understood is financial services was incapable of achieving what high rate of industrial growth, especially in the growth of new and innovative enterprises. Okay, next comes is stage 2, that is after independence till 1990. See, ownership of private sector was transferred to public sector in this stage, which was resulted in what? Nationalization of commercial banks, nationalization of general insurance business, then setting up of financial institutions. Okay, so after independence, they started concentrating on transferring the ownership of the private sector to the public sector so that they can contribute for the development or the growth of the financial sector of the India. Okay, then what are these stages? We'll understand one by one. First one is nationalization of commercial banks. As I've told you, in this stage they have mainly concentrated on what? Ownership of private sector, transferring it to the public sector, right? So nationalization means what here? Nationalization is the process of taking privately called companies or industries or assets and putting them under the control of the government. That is known as what? Nationalization. Let me clear you once again. Nationalization means the process of privately controlled companies will be transferred to the control of the government. So in July 1969, 14 commercial banks with a deposit base of rupees 50 crores or more were nationalized. Again in 1980, 6 more private sector banks were nationalized, bringing up the total number of banks nationalized to 20. Okay, then comes is nationalization of general insurance business. See, nationalization of general insurance business and setting up of general insurance corporation in 1972 and grouped into 4 public sector companies, namely the National Insurance Company Limited, the New India Assurance Company Limited, the Oriental Insurance Company Limited, and the United India Assurance Company. Okay, then comes is setting up of financial institutions. The main objective of setting up of a financial institution was to provide what? Medium and long term industrial finance to the corporate sector. These institutions, that is these financial institutions which were introduced or which were established were as follows. The first one is development financial institution. Will understand this development financial institution according to its years. Okay, see, development financial institutions or development banks are institutions which are engaged in the promotion and the development of industry, agriculture, and other key sectors. Number of development financial institutions at national and at all India level as well as regional or state level were set up. So in 1948, Industrial Finance Corporation of India, that is IFCI, was established. It was expected to provide medium and long term credit to industrial concerns. Next comes is in the year 1951. Under State Financial Corporation Act, the state government could establish financial corporation in India, that is SFCs. So in 1948, IFCI was established. In 1951, SFCs, that is State Financial Corporations, were established. Then in 1954, National Industrial Development Corporation, that is NIDC, was established with the objective of what? Promoting industries which could not serve the ambitious role assigned to it and soon turned to be a financing agency restricting itself to what? To modernization and rehabilitation of cotton and jute textile industries. Okay, next comes is in the year 1955. So see, in 1948, IFCI was established. In 1951, SFCs, that is state financial corporations, were established. In 1954, NIDC, that is National Industrial Development Corporation, was established. Okay, then in 1955, in the year 1955, the Industrial Credit and Investment Corporation of India Limited, that is ICICI, were established as a joint stock company. It provides what? Term loans and take an active part in the underwriting and direct investments in the shares of industrial units. Next comes is in the year 1964, Industrial Development Bank of India, that is IDBI, was set up, and this IDBI was an apex institution in area of industrial finance. Okay, so this is regarding development financial institutions. Next comes is investing institutions. A number of other institutions were also participated in industrial financing by mobilizing public savings through introduction of insurance schemes, mutual fund units, and so on. Okay, a number of other institutions were also introduced so that to mobilize the public savings by introducing what? Insurance schemes or mutual fund units. So these institutions are also called as what? Investing institutions. Okay, this includes Unit Trust of India, which was established in the year 1964, and Life Insurance Corporation of India, which was established in the year 1956, and General Insurance Corporation, which was established in the year 1973. Next comes is other institutions, that is setting up of other similar institutions. Some more institutions were set up to provide help in specific areas. What were the specific areas? Like rehabilitation of sick units, export finance, agriculture and rural development. Okay, this again will understand with the help of the years. In 1971, Industrial Reconstruction Corporation of India, IRCI, was set up for the rehabilitation of sick units. Okay, then in 1982, Export Import Bank of India was established to provide financial assistance to exporters and importers. And again in 1982, in order to meet credit needs of agriculture and rural sector, National Bank for Agriculture and Rural Development, that is NABARD, was introduced. It is responsible for short-term, medium-term and long-term financing of agriculture and allied activities. Lastly, other institutions. Except these, Industrial Reconstruction Corporation of India, Export Import Banks and NABARD, some other institutions are also introduced, okay, such as Film Finance Corporation, Tea Plantation Finance Scheme, Shipping Development Fund, then Newspaper Finance Corporation, Handloom Finance Corporation, Housing Development Finance Corporation also provides financial and other facilities in various areas. In this second stage, the last you can say the last institution which was introduced was commercial banks. Commercial banks diverted the bank credit to industrial sector in the year 1951. See, commercial bank was introduced before independence itself, but these commercial banks diverted the bank credit to what? Industrial sector in the year 1951. Okay, gradually entered into the field of underwriting of issues of capital and term lending. Then Refinance Corporate of Industry was set up as a subsidiary of RBI with the objective of providing refinancing of term loans by the commercial banks. And in the year 1964, this RCI, that is Refinance Corporation of Industry, with IDBI, who extended loans to small and medium scale industries, were merged. Okay, then Entry of major banks. In merchant banking, new issue management, corporate counseling, capital restructuring and portfolio management were introduced. Then number of subsidiaries were also set up by major banks such as Can Bank Financial Services Limited, PNB Capital Services Limited, then SBI Capital Markets, and so on. Okay, why? To carry out long-term financing of industrial sector. So this is the second stage, which is after the independence till 1990. So remember, in the first stage, okay, the financial sector was not so organized, okay, and in the stage 2 it gradually started organizing by transferring the ownership of private sector to the public sector. For that purpose, it has introduced the activities like nationalization of commercial bank, general insurance business. Then it has established some financial institutions like development financial institutions, then investment institutions, then other institutions, and commercial banks. Okay, the next comes is stage 3, which we will discuss in the next class, because if we will discuss the stage 3 in the same class, you people will get confused. So better we'll discuss this stage 3 in the next class. Thank you.